Hey all, welcome back to the GMT channel. Today's topic is asset valuation. This is the 20th session on private equity interview questions. So, do you know about asset valuation? How PE fund do? So, what if I told you that the simple mistake in valuation could cost investor a millions? Yes, it's possible. Ever wonder how big player like SoftBank decide the value of the $1 million investment? Today we are breaking down the asset valuation in private equity, and trust me, this is where the rest money game happen. So asset valuation is in private equity firm invest in the private companies, but how do you decide what company they are worth or not? Asset valuation is a process of determining the market value of their investment who the private equity firm invests, whether it is a equity, debt or hybrid. And here is a catch: unlike the stock, they have a clear market price. Private investment don't have trade daily, making valuation a challenge. So private equity invest privately into this directly into the company, startup, venture, or maybe IPO. Is not listed in the stock market, which are listed every day in the market like NSE or BSE. So could not able to identify a clear picture of the what they have invested. Like for example, they invested in Reliance and Wipro. So in NSE BSE we can able to daily basis we can see how the price is increasing or decreasing. But due to private equity firm invest into the privately into company buying the stake and all, so it is difficult to manage the complex valuation there. So how it will impact into the statement and what is matter. Okay, let's discuss this part. So, valuation asset correctly is crucial for determining the NAV and calculating the management fee performance incentive. Incorrect valuation can mislead investor as well. So, sometimes affect the NAV, management fees, performance calculation, and all this thing. So, sometimes it will be not good at a part of investigating and all. So there is a exception in is there is exception in the accounting? Yes, there is an exception. Not all the assets are easy to value in liquid investment. Early stage startup don't have the public market price as well. So difficult method apply DCF, uh, comparable multiples, fair value valuation accounting like SoftBank Vision Fund use for the company like Uber and VBook. So there are some if there is some complex thing to evaluate all the asset valuation for the private equity firm, there are some method are there, which is called the discounted cash flow DCF, comparable material multiples and fair valuation accounting like SoftBank are using, and Vision Fund are using accordingly. So this is mainly used for the Uber and VBook is example I have given. Accordingly it will done. So there is some example as well. A private equity firm invest 20 million in startup value at 50 million. 1 year later, the startup scale and individual appraisal network now is 80 million. The private equity firm stake grow from the 20 to 32 million, and the why is valuation is crucial. If the valuation is infected, is mislead the investor, distort net value asset, and even impact the fees paid to the PE manager as well. So sometimes if some valuation is not get correct, so it affect all around the thing. So now we look one example of the asset valuation, how it's impact into the financial statement, and then we'll move to the conclusion. So this is an example. A private equity firm invests in startup 50 million valuation based on the last funding round. A year later, the stock revenue growth and individual appraisal value goes to 80 billion million, and the P firm stake appreciate accordingly. So company valuation is 50 million. P firm whatever they invested 20 million, and PE stake is 40%. 40% they have taken 20 million, and PE stake in 20 million. So 1 year later, the valuation goes to 80 million. PE firm investment is 20, PE stake is 20, and now the PE stake value grows to 32 million. So stake is same, but due to valuation increase, the value of the PE firm automatically it get increased. So it is a vice versa situation. Sometimes if fund not perform well, so it will decrease also, and PE stake will remain same. So asset valuation are important in part of a NAV calculation, in part of a financial reporting, in part of a distribution of the fees. Fees may be the performance fee, may be management fee, or some other fees as well. And sometimes it is also important to give the overview or clear picture to the investor, which may be LP or GP, because they are also getting accordingly their carried interest catch up, we can say, or the preferred return according to the what day return is there. So in short, we can say that this is at asset valuation is important, because every investor should know their performance of the fund. So next time you hear about $1 million valuation, remember it is not a just number, it is a high stake game. Hit the like button if you found this insight very wonderful or insightful, and if you want more deep dive into the financial strategy, don't forget to subscribe. Let's decode the finance together. So thank you so much for watching. We'll meet you on the next video.